Subcommittee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I want to thank our witnesses for being here today. It's an outstanding panel, and I now recognize myself for 4 minutes to give an opening statement. Today, I'm very excited to hold the inaugural meeting of the new Subcommittee on Digital Assets, Financial Technology, and Inclusion. To start, I want to thank Chair McHenry for asking me to lead this new subcommittee and for his leadership in recognizing the important need to comprehensively address the topic of digital assets. I also want to thank Ranking Member Waters for her foresight in holding that first Libra hearing back in 2019 and for creating the task forces on fintech and artificial intelligence and for her continued engagement and willingness to work in a bipartisan manner. Finally, I'm looking forward to working with my good friend from Massachusetts and the ranking member of this subcommittee, Congressman Lynch. He's always a thoughtful partner, and we're reprising our roles that we had together leading the FinTech Task Force a few years ago. To all the members of this committee, no matter what your views are about crypto, it's imperative that we recognize the unique role of Congress to legislate, and that no amount of enforcement actions or regulatory guidance can ever replace that or be a substitute. As a legal matter, only Congress can establish the regulatory framework for digital assets, and I strongly believe that we need that in this country. That's why this subcommittee is holding its first hearing to examine the administration's recent actions on digital assets. But let me be very clear. This hearing is not a partisan attack on the Securities and Exchange Commission or the banking regulators. We will hold other hearings to discuss the comprehensive policies, as well as the fraud and failure of FTX and Sam Bankman-Fried and the millions of people hurt by his dishonesty and scam. But it's absolutely critical that we first discuss the scope and significance of recent regulatory pronouncements and supervisory failures of the past year. By assessing the regulatory gaps, supervisory failures, and enforcement actions, we can build the case for a shared bipartisan vision of this regulatory framework. This shared goal is to protect investors, foster innovation, and ensure that America continues to lead rather than follow in this space. But by that means, Congress has to do the hard work of working across the aisle to reach a consensus and not just posturing or sticking our heads in the sand. That's why I was so glad to see Ranking Member Waters recently call on the Treasury, the Fed, the CFTC, and the SEC to get together with Congress and address digital asset regulation. We can't have the agencies trying to front-run the legislative branch. Last Congress, this committee under then-Chair Waters and Ranking Member McHenry made good progress on payment stablecoin legislation, and I believe we should work together on a product that can pass out of this committee with bipartisan support. The Treasury and the Fed were constructive partners in that process, and we want that to continue. That being said, payment stablecoins are just one part of the broader digital economic system that I hope we can bring customer protections that exist in the current financial regulatory system and cover digital assets. I'm a strong proponent of the theory and the approach. Same risks, same activities, same rules. And I believe we should create a functional framework that's tailored to the specific risks of digital assets. In fact, we need to support technological innovation. We need to ensure appropriate controls and accountability. We need to give no quarter to fraudsters, scammers, or criminals, and we need to reinforce leadership in the global financial system for U.S. competitiveness. These are the administration's own principles as outlined in their executive order for their looking at digital assets. So I look forward to hearing from our witnesses and the impact of the administration's approach and how Congress can work together on that. And with that, I yield back, and I yield to my friend, the ranking member, for an opening statement.
Thank you very much, Mr. Chairman. Let me congratulate you and as well Congressman Warren Davidson as Vice Chair on your recent elevations It was an honor to serve with you as the chair of the Task Force on Financial Technology last Congress, and I hope that we might continue some of the work that we began in that committee, in that task force. We can play in which we can immediately find common ground. Innovation has the potential to increase the accessibility and lower costs of financial service products, but I am also likely to exercise some caution about the risk to consumer financial data, some of the hidden fees, the lack of transparency, the misleading marketing practices that were heretofore exercised in this industry. I plan to continue to voice those concerns in this Congress. I do remain optimistic in the potential for great innovation in financial services and the myriad possibilities of blockchain technology. Given the collapse of much of the crypto industry this year, including the recent news involving Silvergate Bank and the scrutiny over Binance's practices, I have some lingering concerns about the volatility and risks that crypto assets pose to consumers, particularly low-income and underrepresented communities. The collapse of Terra USD, Celsius, BlockFi, and FTX speak to the larger regulatory gaps in this space, including lack of corporate controls, inadequate liquidity or reserves, commingling of assets, and irresponsible practices. I do worry that these practices exist across the industries and are a result of insufficient oversight and lack of regulatory guidance. I commend the actions of our administration, the Biden administration, through its reports, guidance, and executive orders to thoughtfully examine the benefits and risks of crypto products. I also have concerns about the exposure of crypto companies to our traditional banking system. I'm encouraged to see that our prudential banking regulators are recommending caution. Yesterday's announcement about the liquidation of Silvergate Bank illustrates why we need a separation between crypto assets and the traditional banking system, and why the guidance from the Fed, OCC, and FDIC is needed. Prior to the collapse of the crypto industry, the hype was astounding. From celebrity endorsements to Super Bowl ads, companies sold crypto assets as revolutionary products that would transform our financial ecosystem. Crypto companies deliberately misled consumers about the risks of their products, some even going so far as to falsely claim that their products were FDI insured. It's clear that Congress must play a role in reining in some of these crypto companies. While I'm confident that my colleagues across the aisle agree that we need a legislative solution to the digital asset space, how we get there may pose a challenge. There appear to be conflicts between the crypto industry and the SEC surrounding how crypto assets should be regulated. Chair Gensler has stated that the vast majority of crypto assets are indeed securities, as illustrated and defined by the Howey test, and should be regulated as such. Crypto companies must come to compliance with existing security laws that ensure that investors and markets are protected. The crypto industry and many of my Republican colleagues have spun a false narrative that the SEC regulates through enforcement and makes it impossible for the industry to come into compliance, when in reality, the SEC is enforcing the law and has provided appropriate direction. These arguments also conflict with the accusation that the SEC did not go far enough in taking actions to prevent the FTX collapse. This attack on the SEC is a tactic employed by the crypto industry to evade compliance with the laws because the industry knows that it would not meet the justifiably high standards that make our financial system the envy of the world. In closing, I'm disappointed that the consumer's voice has been missing from all these conversations, and I am disturbed by the way in which crypto companies, specifically in the past, have targeted low-income and minority communities. Many have made misleading claims about the promises of their products, such as faster payments, lower cost remittances, and wealth-building vehicles. This type of predatory inclusion is not unique to the crypto industry and has been common in fintech and is reminiscent of the 2008 financial crisis and prior events. So I plan to explore these issues more this year. I urge my colleagues to look beyond industry talking points about regulatory overreach, and instead, I ask that we direct our attention to thoughtfully addressing the risks of the crypto industry, as well as as its potential. Thank you. I yield back.
I thank the gentleman from Massachusetts. I look forward to working with him. And now I'll turn to my colleague, the chairman of the Housing and Insurance Subcommittee and the vice chairman of this committee, Mr. Davidson, for 1 minute.
Thank you, Chairman. The regulatory environment for the digital asset ecosystem has come to a critical inflection point. Because there are no clear rules of the road for centralized digital asset trading platforms that list non-security digital assets, American users, our constituents and consumers, are not adequately protected while participating in these markets. It is our job in Congress to craft appropriate fit-for-purpose legal framework for these assets and this space. It is our job, it is our duty, it is long overdue. We must establish clear rules for trading platforms that provide Americans with the necessary protections and ensure market integrity. However, these rules must provide the clear framework that is flexible enough to accommodate innovation. These rules must also preserve Americans' ability to self-custody their digital assets. Congress must do everything in its power to ensure that American citizens can access this transformational technology and have the right to possess their stake and ownership right, private property, in the technology. Preserving self-custody is a critical step in this effort. Because of this, I am working on reintroduction of the Keep Your Coins Act to protect Americans' ability to manage their own digital assets and to make permissionless peer-to-peer transactions. Thank you for your attention, and I look forward to diving into these critical issues with our witnesses today.
Thank you, Mr. Davidson. Today we welcome the testimony of Mr. Mike Belshew. Mr. Belshew is a 30-year Silicon Valley veteran, co-founded BitGo, a digital asset financial services provider where he currently serves as CEO. We also have Professor Tanya Evans. Professor Evans is a full tenured professor at Pennsylvania State University, Dickinson School of Law, specializing in entrepreneurship, innovation, intellectual property, new technologies such as blockchain and digital assets. Mr. Jonathan Gould. Mr. Gould is a partner at Jones Day Law Firm where he specializes in bank and financial regulatory strategy. Before Jones Day, he served as the Senior Deputy Comptroller and Chief Counsel for the Office of the Comptroller of the Currency. Mr. Paul Grewal. Mr. Grewal serves as Chief Legal Officer at Coinbase since August of 2020. Mr. Grewal can provide perspective on how digital asset products, services, and firms can be incorporated in the U.S. framework. And finally, our final witness, Mr. Lee Reimer. Mr. Reiner is the Policy Director at Duke Financial Economics Center and lecturing at Duke Law School. We thank each of you for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. We'll start with Mr. Belshew. You are recognized for 5 minutes for your oral remarks.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for the opportunity to offer testimony today about the digital asset regulatory environment in America. I am co-founder, CEO of BitGo, an institutionally focused digital assets company based in Palo Alto, California. We've been building regulated products and platforms for digital assets, are regulated by numerous state and federal regulators, including New York Department of Financial Services, South Dakota Division of Banking, the SEC, and FinCEN. We're primarily known for our role as the first purpose-built digital asset custodian. Trust companies are different than banks in that we are not depositories. We do not lend assets. We are solely focused on the technology and compliance related to the safekeeping of our clients' assets in segregated accounts. I hope it is clear that BitGo and all of the regulated firms building digital asset technologies and services in America are absolutely and unequivocally committed to preventing financial crime, providing the utmost in investor protections, abiding by sanctions controls, building safety and soundness in our custodians and banks, and building stable market structure. We are not seeking to avoid regulatory oversight. We are not here for the purpose of building speculative assets and markets. We are here to make the financial services system better. It's been over 10 years now since the invention of Bitcoin and the blockchain unlocked the creation of digital property and the ability to transfer digital property in a peer-to-peer fashion. This seemingly simple technology has profound effect, enables the instant transfer of value between anyone across the globe. It also creates smart contracts, which have the potential to replace much of modern finance in a more transparent and fair manner. Stockbrokers, money managers, and market makers can all be implemented as transparent code. So innovation is what I want to talk about today. Software has a tendency that once it enters an industry, it pushes innovation and change faster than that industry has ever experienced before. And that is what has happened to our financial industry in recent years. Software is changing it fast. But unlike other industries in which software has upended, American finance is highly regulated. It's not enough for our businesses to move quickly. Our regulators need to move quickly too. And if they don't, we will all be surpassed by other nations who will. When BitGo decided to pursue a trust company charter back in 2017, we first reached out to the OCC for federal oversight of our safekeeping activity. At the time, the OCC clearly stated that it would not allow a charter for any business in the digital asset space. So we instead pursued a state-chartered trust company. This left us with a question as to whether our fiduciary safekeeping powers would be considered a qualified custodian in the eyes of the SEC. To answer this very basic question of how to provide custody of assets to regulated firms under the Investment Advisors Act, BitGo proactively and voluntarily approached the SEC back in 2018 and submitted a formal no-action letter to the SEC. Ultimately, the SEC declined to opine on our letter. When the OCC closed for business and the SEC willing to answer, the question remained, how to custody digital assets under the Advisors Act. That question has lingered for years until just a few weeks ago, when the SEC issued a draft amendment to the custody rule. While we're happy that the amendment affirms that BitGo's state-chartered fiduciary trust company is indeed a qualified custodian, it took over 4 years to answer that single question. If it takes that long to answer the most basic of questions, how can we expect to answer the myriad of other questions that will follow without falling behind global competing markets? 2022 was an undeniably miserable year for digital assets, with a number of dramatic failures in the system. This has led opponents of the digital assets to wrongly proclaim, "I told you so, digital assets are unsafe for banks and the financial system." But the underlying problem is not caused by including digital assets in our markets. The problem is caused by excluding digital assets from our markets. Our regulatory failure to keep pace with innovation has created a regulatory exclusion which is directly responsible for harming the very investors that we are supposed to protect. In 2020, the OCC briefly opened its doors to digital assets and encouraged OCC-chartered custodians to participate in the market. This was short-lived, however, and the door was closed less than a year later with no plan for regulators as to what the right approach should be. At some point, we have to ask ourselves the question, why do Americans flock to weak digital asset opportunities that are managed offshore? The reason is not because they want to. It's hard to do and risky. The reason is because we have failed to keep pace and to create safe paths to invest under the safety of American regulatory supervision. Thank you very much.
Thank you, sir. Ms. Evans, you're recognized for 5 minutes. Stand by. We're working on a mic tech. Stand.
Okay. To Chairman Hill, Ranking Member Lynch, and distinguished members of the subcommittee, thank you for the opportunity to testify today about the current U.S. regulatory landscape as applied to emerging crypto asset ecosystems. I viewed today's hearing through a nonpartisan academic lens, and I accepted the invitation to help inform and calibrate the conversation about the current regulatory environment in this latest wave of financial and technological innovation in a $1 trillion emerging market. I also wish to express concerns about the future of America's leadership in innovation in this area when a powerful agency uses its broad discretionary powers on a piecemeal basis without also providing commensurate clarity for regulated parties or a fair opportunity for good faith actors to understand the rules and the consequences that apply in an entire industry. And I intend to also highlight the tremendous loss of wealth accumulation opportunities for communities of color, especially the Black community, if investment and innovation opportunities in the crypto asset ecosystem are driven offshore. Accordingly, as Congress considers how best to reevaluate its delegation of powers to the SEC and whether to empower the CFTC further in some capacity, I offer 3 points to consider. One, given that the heads of the SEC and CFTC do not actually agree on the character and nature of whether and under what circumstances certain crypto assets, especially Ether, are commodities or securities, reconsider bipartisan legislation across oversight committees that would clarify the taxonomy of crypto assets, limit unpredictable and incongruous executive agency actions, and consider empowering the CFTC to regulate spot crypto asset markets. 2, ensure that all citizens, especially those who have been systemically marginalized, have equal access and opportunity to thrive safely, legally, and confidently in the future of wealth and innovation. And 3, request the SEC chair to appear before congressional oversight committees to explain how its current practice of an aggressive piecemeal approach to regulation of crypto assets comports with efficient and effective regulation, and how this practice aligns or doesn't with the legislative mandate to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation. I want to punctuate briefly my concerns that in this latest economic boom, systemically marginalized populations will continue to be left behind when, under the well-intentioned guise of investor and consumer protections, and as well as not so well-intentioned streams of fear, uncertainty, and doubt from legacy financial institutions and other parties with vested interest in seeing the crypto economy fail, that wealthy early adopters and legacy institutions protecting their high net worth clientele will again reap the upside risk and reward of early adoption, leaving another generation of systemically marginalized people behind. For example, legacy financial institutions have seized the early mover opportunity among their peers to innovate in delivering products and services in the digital future by leveraging blockchain technology or offering direct or indirect exposure. Despite public comments injecting misguided narratives about crypto assets, major banking and financial institutions like Deutsche Bank, Morgan Stanley, and even longtime Bitcoin skeptic JP Morgan have all recognized the value proposition of crypto and blockchain. So in conclusion, the technology and opportunity to include crypto assets, taxed as capital assets, in a portfolio or build new and innovative products for the decentralized web, or reskill to bring a legacy company into the future of innovation, or prepare students for the future of work and industry, or to sit before this esteemed body today with a seat at the table to inform and influence the direction of legislation and regulation of digital money. With every country, including the United States, working on its own protected sandbox of digital asset innovation, private markets deserve the same, to innovate safely, legally, and with clarity right here in the United States. Again, thank you for this opportunity, and I look forward to your questions.
Thank you, Professor Evans. Mr. Gould, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, thank you for the opportunity to discuss the administration's actions with respect to the digital asset ecosystem. I am speaking today solely in my personal capacity. I'm not speaking on behalf of any clients or of my law firm. My testimony is my own. Over the last 18 months, the federal banking agencies have issued a number of public guidance documents. This guidance has articulated agency concerns with risks associated with digital asset activities of banks, expressed their skepticism that many of these activities can be conducted in a safe and sound manner, and impose procedural barriers to their commencement. My written testimony summarizes these guidance documents. The pace and coordination of these issuances have increased this year, with 2 joint agency statements in as many months, and an important policy statement from the Federal Reserve. As Congress considers the actions of the federal banking agencies, there are 3 attributes of bank supervision that I would like to highlight. First, bank supervision is by design confidential, particularized, and potent. Although the agency issuances I mentioned are public, their application is not. The confidential nature of the supervisory relationship facilitates the flow of information between bank and regulator, but it can also frustrate accountability and oversight. Second, safety and soundness, the primary lens through which these agency issuances are framed, and the goal of prudential regulators like the OCC, Federal Reserve, and FDIC, can be a subjective concept. Banking agencies have issued thousands of pages of public non-binding guidance detailing their interpretations of what safety and soundness means in a variety of contexts to help banks achieve it and to facilitate consistency in the agency's supervisory expectations and approach. Finally, although agency guidance is technically non-binding, banks rarely challenge or disregard it. The practical consequences of doing so can be significant in light of the supervisory process through which guidance is applied. Given these attributes of bank supervision, generalized and negative statements raising safety and soundness concerns about particular industry sectors must be made carefully, lest they be interpreted by the public or bank examiners as an outright prohibition. Anecdotal evidence suggests that agency actions over the last 18 months, while responsive to developments in the digital asset ecosystem, are indeed having a chilling effect on banks' practical ability to engage in digital asset activities, as well as their willingness to entertain or maintain digital asset entities as banking customers. Because of the confidential nature of the supervisory relationship, it is impossible for the public to assess the actual causal effect of these agency actions. There are several areas that would benefit from congressional attention. First, the agency's actions might be disproportionate, whether in nature or magnitude, to the risks posed by digital assets. Relatedly, the strategy to address the risks posed by digital assets may be less than optimal. Risk elimination strategies are often less effective over the long term than risk management strategies, as the former tend to push financial risk into less visible corners of the economy, where our ability to monitor and manage it can be challenging. Second, the agency's actions might be overbroad and risk chilling innovative activities, precluding banks from exploring new technologies like distributed ledgers or decentralized networks to achieve traditional banking activities like payments or deposit taking, risks diminishing the important role played by banks in our economy. Finally, safety and soundness pronouncements are, in some sense, a reflection of the agency's risk tolerance for individual banks and the banking system as a whole. Congress should have a key role in defining the risk tolerance of our banking system, especially when it involves industry-specific attention, as seems to be the case here. And if it disagrees with the agency's risk assessment or risk tolerance, it can and should do something about it. The confidential nature of the supervisory relationship necessarily limits the public's ability to assess the actual effects of the banking agency's guidance. Congress is not so limited. It has the oversight ability to move beyond anecdote to examine how these guidance documents are being implemented and their effect. Armed with this information, it can then make an informed decision about the propriety or prudence of the banking agency's actions. I encourage it to do so. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you, Mr. Gould. Mr. Graywall, you're recognized for 5 minutes.
Good afternoon. Thank you, Chairman Hill, Ranking Member Lynch, and members of the subcommittee for inviting me to testify today about how crypto can make our financial system better and why we need new rules for crypto. I also wish to express my appreciation to Chairman McHenry and Ranking Member Waters. My name is Paul Graywall, and I'm the Chief Legal Officer at Coinbase. Coinbase was founded in 2012 with a mission to increase economic freedom in the world and to be the most trusted, secure, and compliant on-ramp to the crypto economy. We are the largest crypto trading platform in the United States and became a public company on April 14, 2021. Our products enable tens of millions of consumers, institutions, and developers in the United States and more around the world to discover, transact, and engage with crypto and Web3 applications in a safe and reliable way. Today, I would like to share with you 3 points that underscore the urgent need for sound rules for crypto. First, we need to update our financial system, and the time to act is now. 80% of Americans believe the financial system is unfair, and 67% believes it needs a serious upgrade. Crypto, along with the blockchain technology that underpins it, should be part of the solution. With 20% of Americans holding crypto today, the American people are voting with their feet and their wallets. They want a financial system that is easier, faster, and more efficient. They are already using crypto for payments because it's cheaper and secure. They are sending remittances to family and friends in countries where the local currency is unstable and creating a lifeline in places that are being torn apart by war. In Ukraine, for example, the power of crypto is obvious. The country has embraced crypto to raise money for humanitarian efforts and to reduce stress on its financial system since the invasion by Russia. Simply put, crypto and blockchain technology are helping to make the financial system operate more efficiently and securely. With just a phone and an internet connection, Americans and individuals around the world can securely and safely transfer value or ownership. Second, if we fail to adopt rules that both permit and foster this next generation technology, the United States will lose its position as a global leader in finance. The rest of the world is not waiting for us. The European Union, the UK, Australia, Hong Kong, and Singapore, just to name a few, are putting in place regulatory frameworks that are creating high standards for crypto. America seems to be the only developed country dragging its feet. As other countries are bringing crypto safely into the regulatory perimeter, we should be doing the same. We should not be pushing it into the shadows and hoping it will simply go away. It will not go away. Crypto is built on a transformational technology that consumers want and innovators know can make our financial system better. This is a race to the top that the United States cannot afford to lose. Third, we need to protect consumers. Emerging technologies can attract bad actors, and crypto has seen its fair share. We need a regulatory framework that both promotes the benefits of crypto while keeping people safe. On this, we do not need to compromise. For our part, Coinbase has embraced consumer protection and regulation for over a decade. We protect consumers by prioritizing prudent risk management, employing rigorous standards for listing digital assets, and fighting every day against illicit finance, market manipulation, and fraud. Let me be clear. Coinbase fully complies with sanctions and all anti-money laundering rules in the United States and abroad. We work tirelessly with law enforcement and have built and continue to build industry-leading tools to help find and stop criminals. We also protect customers through transparency. As a public company, we disclose audited financial statements, our methods for safeguarding customer assets, our business operations, and any risk factors as part of our quarterly reporting. That makes Coinbase distinct in the crypto economy. But transparency is not enough. We need clear rules that work. To that end, last July, we filed a petition for rulemaking with the SEC. We provided 50 questions that need to be answered to create a registration pathway for crypto developers and trading platforms like Coinbase. These regulatory issues are complex, and Americans are best served by having the opportunity to engage with their government on decisions that affect their everyday lives. Although the SEC could resolve these questions under existing authority, we also urge Congress to act. The 20% of Americans who already own crypto need clear rules just as much as Coinbase and the rest of the industry. Legislation should contain strong consumer and investor protection standards for digital asset intermediaries, create a registration pathway for offering digital asset securities and non-securities, and develop a comprehensive framework for stablecoins. In closing, we need to get the rules right for crypto. Imagine if the United States failed to embrace the transformational potential of the internet in the 90s or smartphones in the 2000s. Without pro-innovation regulation, we live in a far less connected, enriching, and dynamic place. This is the approach we need to take with crypto. We don't want to be looking back, thinking what if. I look forward to answering all of your questions. Thank you.
Thank you, Mr. Graywall. Mr. Reiner, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and distinguished members of the subcommittee. Thank you for inviting me to testify at today's hearing. My name is Lee Reiners, and I'm the Policy Director at the Duke Financial Economics Center and a lecturing fellow at Duke Law. At Duke, I teach courses in cryptocurrency law and policy and financial regulation. Prior to entering academia, I spent 5 years examining systemically important financial institutions at the Federal Reserve Bank of New York. The title of today's hearing implies that the main impediment to the growth and success of the digital asset or crypto industry is regulation, specifically overzealous enforcement by existing financial regulatory agencies. But I would argue that the crypto industry's main problem is the product it is selling. Cryptocurrency is wholly unconnected to the productive purpose that defines finance, which is helping businesses, individuals, and governments raise, save, transmit, and use money for socially and economically useful ends. This leaves you with an asset class with no fundamentals that trades entirely on sentiment. In fact, I have repeatedly asked crypto proponents to explain their valuation methodology to me, and I have yet to receive a straight answer. Despite this inherent flaw with their product and the fragilities revealed by the implosion of FTX and multiple other crypto entities over the past year, the crypto industry wants us to believe that their salvation lies in Congress granting them, quote, regulatory clarity. But regulation is not some magical pixie dust you can sprinkle on an asset class and transform its fundamental essence. The truth is that the crypto industry wants the same thing as every industry that came before: light touch regulation and favorable taxation. Most of the crypto industry's ire is directed towards the SEC for simply doing its job. It is important to remember that Congress intentionally crafted our securities laws to be principles-based. In the seminal case SEC versus Howey, the Supreme Court found that the term investment contract, quote, embodies a flexible rather than a static principle, one that is capable of adaptation to meet the countless and variable schemes devised by those who seek the use of the money of others on the promise of profits. Cryptocurrency and blockchain technology are simply the latest scheme deployed by those seeking to profit from other people's money. And despite the industry's claims, the SEC has been clear and consistent about crypto, dating to the chairmanship of Jay Clayton. Both Clayton and his successor, Gary Gensler, have said most cryptocurrencies are securities that need to be registered with the Commission. The SEC has also brought over 130 cryptocurrency-related enforcement actions, and they have yet to lose a single case. For any neutral observer, the law is very clear. The SEC is not a merit-based regulator. Anyone can raise money from the public, regardless of how bad the business idea may be, provided they register with the Commission and disclose the relevant risks to prospective investors. However, the entity must have something to disclose if they are to register. Imagine a corporation approached the SEC because it wanted to do an IPO of common stock, but the company had no cash flows or a credible plan to generate cash flows, no audited financial statements, and the stock it was selling conferred no legal rights on the purchaser. If the SEC told that corporation that it wasn't ready to sell to the public markets, would you say that the SEC is acting inappropriately? Incredibly, many token issuers and crypto firms who fit this example claim that the SEC is treating them unfairly. I applaud the SEC and other financial regulatory agencies for enforcing the law. However, more must be done. While I agree with Chairman Gensler that most cryptocurrencies are securities that are subject to registration and disclosure requirements, some cryptocurrencies are most likely commodities. While the CFTC regulates commodity derivatives, they do not regulate commodity spot markets. The practical effect of this structure is that cryptocurrency exchanges in the US are presently not regulated at the federal level. In my written testimony, I provide a detailed roadmap for how Congress can close this gap by carving out cryptocurrency from the definition of commodity in the Commodity Exchange Act and recognizing cryptocurrencies as securities under a special definition to the securities laws. This would give the SEC exclusive authority to regulate all aspects of the crypto industry. I realize that giving the SEC additional authority under its present leadership is unpalatable to some members of this committee. However, SEC chairs come and go. The American people are looking to Congress to exercise foresight in determining how to regulate the crypto industry for the long term. The SEC was endowed with a mandate to protect investors, and investor protections are sorely lacking in crypto markets. I appreciate the committee's focus on this crucial task, but it is worth noting that this is not a race. As you know, passing financial regulatory legislation is hard, and once in place, it tends not to change absent some future crisis. I look forward to working with you to make sure we get it right the first time. Thank you.
Appreciate your testimony. We'll now turn to members' questions, and I'll recognize myself for 5 minutes. Well, first, let me say thanks to the panel. It's an excellent, diverse set of views on a very complicated subject. So all of you have been very helpful to our committee. We're grateful for that. And even inside a regulated framework, we have huge dislocation and the potential for malfeasance, fraud, and there's just plain mismanagement. Look at the dot-com boom, which was fully under the scope of the SEC, and between March of 2000 and October of 2002, $5 trillion were lost by people who followed the rules effectively. And I'm excluding WorldCom and Enron and that pure fraud. I'm just talking about, Mr. Reiner's not buying his pets on pets.com. And so then you go to the next crisis in our society, which was the mortgage crisis, created by the policies of the Bush and Clinton administrations for housing, and fully under the most regulated thing on the planet, and yet it was taken advantage of, and there were huge losses that led to the '08 crisis. So we all recognize that inside or outside a regulatory framework, we can still have huge financial challenges and criminal issues as well. And so, in my view, you're better off with that regulatory framework, and I think each of you have given your perspective on that. SEC Chair Gensler has insisted that the SEC's 2019 framework provides sufficient clarity now for market participants to apply to the securities laws to the digital asset ecosystem, and he's repeated on his routine CNBC appearances and other television appearances that one just has to come in and register is sort of a theme for him, and that he'll work with them, and that's how it's going to be since 2019, and it's been effective. So let me start with you, Mr. Graywall. You're the chief legal officer for one of the largest and most recognized platforms. What does that look like in practice? Is there a path for companies to come in and register as a national securities exchange?
Thank you, Chairman Hill. The answer to your question is, at present, no. And I say so definitively because Coinbase very much wishes to register with the SEC. We do not currently list digital asset securities, but we have a great interest in making these products and services available to Americans who want them. In order to be able to do that, a national security exchange registration must be made available. Perhaps alternatively, a broker-dealer or ATS alternative might be considered. But in either case, we have not been able to successfully register with the SEC despite our best efforts and despite conversations with the Commission that go back now many, many months.
Thank you for that. How about BitCo's experience, Mr. Belshie? How was your experience in come in and visit, and can you come in and register in your experience?
As I mentioned in my testimony, we did visit the SEC all the way back in 2018. It's worth noting that this is not the current administration's SEC. This is the prior administration's SEC. So the problem is not any specific administration. It's actually systemic to just getting questions answered. The basic question of how should those covered by the Investment Advisors Act have custody obviously should be answered. Second point to note is the common problem around ruling by enforcement as opposed to ruling by direct answering of what is allowed and what's not. Recent enforcement actions around staking as a service left the entire industry confused. We can see in an enforcement action a long list of potential problems that the SEC might have with that particular product, but we can't tell exactly which parts of that were specifically problematic and if any of those parts of that service were acceptable behaviors.
Thank you. Let me turn to Mr. Gould, switch subjects. I think that tells me that come in and register is not quite as straightforward as perhaps it's being presented by the Commission. Mr. Gould, I'm looking at American Bankers Association statement for the record. Prudential regulators have instructed banks to proceed in the digital asset ecosystem with extreme caution, requiring advanced supervisory notice and formal approval. And yet it says banking agencies are not prohibited or discouraged from providing banking services to customers. That seems kind of contradictory to me. So you referenced risk elimination versus risk management. So as a former comptroller, how do you look at, how should the banking agencies look at that?
Well, the way I think about safety and soundness guidance is that it provides a path, one path, to get to how to do the activity and perform the activity in a safe and sound manner. I think a lot of the guidance that we're seeing is more negatively phrased. It's focusing on kind of the the risks associated, but it's not necessarily showing any kind of credible path to actually be able to perform whatever the activity is in a safe and sound manner.
Thank you. My time's expired, and let me turn to the ranking member for 5 minutes.
Thank you, Mr. Chairman. Mr. Reiners, we hear that that's been suggested that the, come on in and register model doesn't work. Are there deeper reasons in your mind as to why these crypto firms are unwilling to come in and register with the SEC?
Yeah, thank you, Congressman. So it's important to note that the crypto industry, despite knowing the rules, has willfully chosen to operate outside the regulatory perimeter. I think the main reason that they haven't come in and be registered is because it would be unprofitable for them to do so. When you look at crypto platforms or exchanges, how they're currently structured, that model is not allowed in traditional securities markets. You cannot be the broker, the exchange, the market maker, the clearing agent, the custodian. In some cases, they have venture arms that are investing in tokens that they end up listing. Hey, you can't do that. A national securities exchange has to make themselves open to registered broker-dealers. Okay, so the reason that they're not coming in and registering is because it'd be unprofitable for them to do so. And they're trying to convince you and the public that the SEC is acting unfairly and arbitrarily when they're making a deliberate choice.
Let me go to that point. So, as you mentioned, both the former chair, Jay Clayton, and the current chair, Mr. Gensler, have both taken basically the exact same position with respect to cryptocurrencies. They classify them as, well, most of them, the vast majority of them, as securities. So there's been no difference in terms of Mr. Clayton's position, appointed by a Republican administration, and Mr. Gensler, who was appointed by President Biden. The underlying mission of the SEC, the reason it was created, was to provide a counterbalance to the asymmetry between investors and the industry itself. There was an asymmetry of information, knowledge, expertise between a customer or an investor and the seller of that securities, which is what triggers the whole requirement for disclosure. From my own experience in trying to investigate some of these cryptocurrencies and stable coins, sometimes it's nothing more than a very, very technical, and I have an engineering degree, but very technical white paper, and that is it. That is it for the average person who wants to invest in some of these products. Following the collapse of FTX, a lot of the crypto players attempted to distance themselves by claiming that FTX was the bad apple. But up until that point, up until their collapse, they were actually sort of the model. They were actually an industry leader. And I'm just wondering if you share the concerns or could speak to the potential future risks that can occur in this space if this activity continues to go unregulated.
FTX was just one of many bad apples, so I would suggest that the entire industry is rotten, frankly. And we're going to see more unless we bring this industry inside the regulatory perimeter. We're going to continue to see more everyday Americans get harmed by crypto platforms and crypto firms. FTX, the crypto industry likes to point out, well, it's just like you said, a bad apple. This is not an indictment of crypto or the underlying blockchain technology, but it was all made possible by crypto. FTX was founded in 2019. 3 years later, at the time of its failure, it was $32 billion. That is only possible with crypto, where you can just mint tokens out of thin air. And when you look at how the FTX fraud was run, it was the FTT exchange token, which is what was underpinning the whole thing. Alameda was borrowing customer assets from FTX using FTT, a token that FTX created out of thin air, as collateral. And when users were withdrawing their funds from the platform, FTX was selling FTT. The moment that the Binance CEO, CZ, tweeted that he was selling his stash of FTT, the game was over. So crypto and the unique nature of crypto was what fueled FTX's rise, and it's what made FTX collapse in a blink of an eye.
Thank you, Mr. Chair. Thank you, Mr. Chairman. My time has expired, and I yield back.
I thank the ranking member, and I turn to the distinguished ranking member of the full committee, my friend Mrs. Waters, for her questions for 5 minutes.
Thank you very much, Mr. Hill. Mr. Reiner, recently, Chair McHenry and Subcommittee Chair Huizinga sent a letter to Chair Gensler demanding records and communications between the SEC's Enforcement Division and the Justice Department regarding charges against FTX founder Sam Bankman-Fried and his subsequent arrests. I was deeply perplexed by this approach from our Republican leadership, as the bad actor here is not the SEC, but Mr. Bankman-Fried and his colleagues. So, when I was chairwoman, we regularly brought in the heads of companies to answer to Congress. It is this reason that I wrote to Chair McHenry urging him to compel testimony from Sam Bankman-Fried as soon as possible. Was it wrong for the SEC to bring a civil enforcement against Sam Bankman-Fried for harming U.S. investors? Was the SEC wrong for doing its job?
Not at all. And I applaud the SEC as well as the CFTC for bringing enforcement actions very quickly. And I also should give credit to the Department of Justice and the Southern District of New York for bringing criminal charges very, very quickly. And so Sam Bankman-Fried will have his day in court, and we will learn more about what happened during that time. But I think the authorities acted very quickly and very aggressively, and rightfully so.
Okay, let me continue. Last month, the OCC, along with the Fed and FDIC, released a joint statement on the liquidity risks to banks resulting from crypto market vulnerabilities, including examples of effective risk mismanagement practices. Nevertheless, the California Department of Financial Protection and Innovation announced that Silvergate Bank, a prominent banking partner for crypto companies, was voluntarily began the process of liquidation. This came after the collapse of FTX, which led to a run on Silvergate late last year. It seems to me like these developments validate the bank regulators in expressing caution for banks dealing with cryptocurrencies. Do you agree?
I do agree, and I think this is another example of the banking agencies simply doing their job and enforcing their safety and soundness mandate.
Well, I want you to know that when I became chairwoman, we took a close look at Facebook as it tried to launch its own global stablecoin, which it called Libra, if you remember. When Mark Zuckerberg testified before our committee, I challenged him to not proceed with their project unless they had regulatory approval to do so. Later on, Facebook tried to partner with Silvergate Bank, but Treasury Secretary Janet Yellen opposed this, and Facebook subsequently folded its operation. So given the problems Silvergate Bank and the crypto market are now facing, had Facebook been approved back then, I wonder whether millions of additional investors could have lost their money. So, in light of these lessons we are learning, Mr. Reiner, do you believe regulators are overreaching in their cautious approach towards cryptocurrencies?
Not at all, and I appreciate your focus a few years ago, Ranking Member Waters, on Facebook's Libra project. I think the main reason it generated so much attention was Facebook's scale. I mean, we still live in a fiat currency world. If you use crypto, at some point, you're going to have to cash out. And that's where we can enforce regulation, and that's where I think this committee's focus should be. But because Facebook has over 2 billion monthly active users across its suite of products, Instagram, Messenger, WhatsApp, there was the real possibility that people could be essentially living their lives in Libra. And, maybe someday in the, Mark Zuckerberg's version of the metaverse, they will be again. I don't know. But the reason that Facebook ultimately backed down was because of political pressure and the focus that you and many others here put on them. But from, my vantage point, there was really no legal or regulatory restrictions that forced them or required them to back down. So I think as this committee moves forward and thinks about how to regulate crypto, it's very clear that we button that up and don't allow these big tech companies to issue stable coins or something similar.
So I have to yield back, but let me just say, you said you had some recommendations that you are letting us have access to. I'd love to take a look at those and then talk back with you. Thank you. I yield back the balance of my time, and thank you, Mr. Hill.
Gentlewoman yields back. Now we'll turn to the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Chairman Hill, for holding this hearing, the first of the Digital Assets Subcommittee. And I look forward to working with you and Ranking Member Lynch and the rest of the subcommittee as we look to bring much-needed regulatory clarity to the digital asset arena. I'd first like to focus on the SEC's regulatory approach. The SEC has decided the best way to communicate on what the law is regarding digital assets is through enforcement actions. The SEC contends that digital asset intermediaries can simply go in and register, while at the same time not giving real guidance or any indication of what a special registration process looks like. More practical, I should say. Some would call it special. Professor Evans, could you discuss how to square the SEC's enforcement approach with its mandate to protect investors and maintain fair, orderly, and efficient markets, please?
Yes, thank you for the question. In thinking about the mandate for the SEC and regulating and encouraging and supporting orderly markets, they have quite broad discretion, as you know, and part of that discretion is the ability to leverage the full power that it has. Obviously, Congress cannot become a subject matter expert on everything, and so when delegating your legislative authority to an agency, you're trusting them to use that discretion wisely. Part of that process is also the ability to leverage the tools that they have at their disposal, that is the adjudication procedure and also rulemaking, to selectively use adjudication and to select the actual parties or regulated interests that they would focus on leaves the rest of the industry to wonder, because it's a case-by-case rather than the broad rulemaking or even guidance that would give some perspective to the ecosystem.
Many of the legislative proposals to provide clarity in this space grant the CFTC spot market authority over crypto. Since the CFTC was first established through the Commodity Futures Trading Commission Act of 1974, the agency's been a principles-based regulator. This flexibility, principles-based approach is fundamental to the CFTC's regulatory framework, which enables it to be an innovative and proactive regulator. Now, with that said, the jurisdiction over the spot market authority deserves a robust conversation around what is best for investors, consumers, and even the agencies. Mr. Graywalt, could you share your thoughts on where spot market authority for crypto assets should belong?
Thank you very much, Congressman. You are correct in identifying that spot market authority for crypto assets currently represents a gap in the overall legislative landscape. We would certainly support any legislation which made clear that the CFTC had such authority in order to enforce and establish those principles which are appropriate for the spot market.
Professor Evans, would you like to tackle this question as well?
There is a clear gap and a concerning one when you think of the nature of programmable currency that can change form from commodity to security during the life cycle of a currency, to be sure. So ensuring that there is no gap between derivatives markets on the commodity side and the securities market is critical.
Yesterday, after months of uncertainty, a major lender in the crypto industry, Silvergate, announced it would be winding down and liquidating its bank. Mr. Graywall, there is real anxiety about crypto market downturns, like we're currently experiencing, having an impact on the traditional financial sector. Can you speak to this concern?
Congressman, I appreciate the question. The concern is real and important, and of course legitimate. With respect to Silvergate, we were certainly made aware, as was the rest of the market, that it had made the voluntary decision to wind down operations this week. Prior to this, Coinbase executed on a longstanding plan for the orderly disposition of corporate and customer funds, and so we have no particular exposure to that bank at present. But the issue generally of crypto firms and exposure to banks which may be at risk is an important one. We think transparency offers the solution here. It's very, very important for investors and for market regulators to understand what these risks are, what exposure individual firms may have, and of course, most importantly, for firms to have prudent risk management plans in place so that in the event of a failure, a wind down, or anything else, customer funds are always kept safe. And that's exactly what we think could happen as part of not only legislation, but regulatory oversight pursuant to rulemaking.
My time has expired. Thank you, Mr. Chairman.
Thank you, Mr. Lucas. Now we have the distinguished ranking member of the Financial Institutions Subcommittee, my friend, Dr. Foster. 5 minutes.
Thank you, Mr. Chair, and to our witnesses. A little more than a year ago, when we had Sam Bankman-Fried and various crypto luminaries in front of this committee, I asked them what I considered the foundational question about crypto assets, which is that if we wish to prevent crypto assets from being used for ransomware, if we wish to prevent wash trades and other market manipulation, is there any alternative to having every crypto transaction ultimately associated with a traceable legal identity issued by a country with which we have extradition treaties? And their answer at the time was no, that this was necessary, that if either you're going to have self-custody and if you're going to allow self-custody and permissionless transactions, you will have ransomware and you won't be able to prevent wash trades. Has anything changed in the last year? Is there a magic technology that would allow us to prevent crypto assets from being used for ransomware and so on, that doesn't rely on having ultimately a traceable legal identity, a license plate, if you will, on every crypto wallet? Just for the record, no one volunteered such a magic technology. Yeah. Oh, are you aware of one? Yeah.
I'm not aware, other than if you have every country in the world comply with the guidance put out by the Financial Action Task Force, FATF, around preventing crypto for being used by money launderers, ransomware hackers and whatnot. But we know that's not happening. And when it comes to ransomware, really all roads lead to Russia. I think Chainalysis has said that over 70% of ransomware proceeds ultimately get cashed out in Russia. And certainly OFAC has ramped up its designation activity when it comes to those Russian-based exchanges. But again, it's very easy to open a new one. So unfortunately,
yeah, that's
no.
right. Well, it's the lack of a legally traceable identity from a country that we have extradition treaties. That's where the rubber hits the road on this. So it's interesting that hasn't changed. So the way I view this is that just imagine that we're at the birth of the automobile industry, and someone says, "I've got this great new product called the automobile, but if you ask me to put license plates on the automobile, if you ask for a driver's license for operators, you will crush innovation." And the exact opposite is actually true, that it was essential to the healthy development of the automobile industry that we have this system of license plates, of driver's license, of VIN numbers to prevent, theft in vehicles and vehicle parts. So all of this, and it's something that's recognized by every civilized country. And so there's an analogous licensing regime is certainly technically possible. I had a discussion yesterday with Mr. Grohl about this, and he recognized its utility and its feasibility. It's simply that when you want to possess a crypto asset, you say, okay, get your wallet, now go register your wallet using a secure digital ID, mobile driver's license or passport or something like that, to register yourself and that wallet. And it can be a secret number. It can be cryptographically obscured, but sort of like James Bond's rotating license plates, if you remember the movie. But that would allow you to have the same guarantee that you have with cars. That normally when you're driving down the road, you have no idea who's in the car next to you, but you know there's a valid license plate on it, and you know that if they come into your neighborhood and they run over your dog, you can go to a judge, prove a crime has been committed, and drag that person into court for running over your dog or whatever. And so this has been essential to, it would be completely unacceptable to live in a world where automobiles could drive through your neighborhood or cross international borders with unlicensed operators and unlicensed cars. And so this is the essential thing that has to be provided for the healthy development of the crypto industry. Somewhere there has to be an API provided by a trusted third party to register your crypto wallets. And then at that point it can be, it can be anonymous and everything else. But that's, I think, the essential ingredient that we have to come to terms with, and where I hope this Congress eventually settles as the only way to prevent these from being used for ransomware, market manipulation, you name it. Does anyone have thoughts on this? Well, I'll start with Mr. Grill. You've had 18 hours to think about this concept. And
Thank you, Congressman. I appreciate the opportunity to think another hour or two about this very important subject. What you're describing, sir, of course, is the critical importance of attribution so that we can link illicit activity or other activity, which is properly the subject of government action or civil law action, to individuals. I would also call out and underscore two other points in your comments, which I think are important to any system which makes sense. Court supervision or appropriate government oversight in an independent branch. I think that's critical. You mentioned the importance of extradition from countries that we have treaties with. The point is that we need to be able to, through legal process, link illicit activity to actors who are responsible for that activity. We think there's a way to do this technically that doesn't involve the mass collection of personally identifiable information. I don't think that's what your comments or questions were suggesting, but I think that's important as well so that we can strike the right balance between personal privacy and holding people accountable for committing illegal activity.
thank you.
Gentleman's time has expired. We recognize the Majority Whip of the U.S. House, Mr. Emmer, for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch, for holding this important hearing today. And thank you again to our witnesses for your testimony. Crypto technology is shifting economic power from centralized institutions back into the hands of the people. It's transformational. And it can be threatening to unelected bureaucrats and, quite frankly, some elected people here in Washington, D.C. This threat is most saliently observed through several recent administrative actions. On January 3rd, 2023, the Fed, FDIC, and the OCC issued a statement discouraging banks from holding crypto or servicing crypto clients on a, quote, safety and soundness basis. On February 7th, 2023, the Federal Reserve published a statement in the Federal Register seemingly turning this perspective into a final rule without following the public comment process outlined in the Administrative Procedure Act. In the midst of this, on January 27th, 2023, the White House National Economic Council published, quote, the administration's roadmap to mitigate cryptocurrency's risks. This report summarizes President Biden's political plan to lawlessly abuse the administrative state to push American crypto firms and their United States customers into offshore, unregulated, opaque, and unsafe markets. These recent actions are an explicit display of what Congress and the American people already noticed. This administration is weaponizing the banking sector to debank legal crypto activity here in the U.S., using scare tactics to run an entire industry out of the country. And the collapse of FTX should warn us of the vulnerable position we are putting American consumers in when we don't compete to keep crypto firms on shore. Clearly, the administration's policies are motivated by a thirst for increased control over the American people, because here in Congress, crypto is not partisan. Republicans and Democrats have an 8-year history of working productively together on solutions to this space. Mr. Gould, no regulator has understood the importance of unlocking access to financial services for crypto companies better than the OCC under Brian Brooks. Of course, you did great work on that team, so I'm going to ask you a series of questions that will, I hope, assist our committee's work. First, in your view, is the administration's regulatory posture towards digital assets encouraging or discouraging financial institutions from offering services to digital asset firms?
Discouraging.
In your view, is the administration's regulatory posture towards digital assets encouraging or discouraging financial institutions from innovating themselves and offering digital asset products and services to their clients?
Discouraging.
As it concerns innovation and consumers, what is the potential impact of the administration's negative, wide-ranging statements on safety and soundness with financial institutions engaging in digital asset activities?
One possible consequence is that it drives it into less visible areas of our economy where we can't monitor it, we can't manage the risks associated with it. Another possible outcome is that it increases the technology gap between the larger banks, which continue to invest and expand in technology, versus the smaller banks, which frankly don't have the same resources and aren't able to pursue as aggressively investments in technology.
Can you please give us an example of when an administration has taken this type of regulatory posture toward an industry in the past and what the effects were?
Many people have suggested that it's similar to what happened with Operation Choke Point, but there are important differences. Number one is that what the administration is doing currently is transparent, at least to the extent you can do that within the confidential supervisory system. They've been very clear, to their credit, what their views are and what their concerns are. Number two, though, I think it's different from Operation Choke Point in the sense that, as I understood Choke Point, it was more focused on discouraging banks from banking certain industry sectors. This is actually broader than that, because this also applies to essentially discourage existing banks from exploring new technologies, including digital assets.
Thank you. This administration's attempt to debank the crypto community and prevent financial institutions from offering digital asset products and services to customers is a lazy and destructive regulatory strategy that is already chilling innovation and subjecting users of digital assets to less sophisticated jurisdictions that are not equipped to manage the potential risks. Again, I appreciate everybody being here today, and hopefully we're going to do some productive work going forward. Thank you, Mr. Chair. I yield back.
Gentleman yields back. We turn to the gentleman from New York, Mr. Torres, for 5 minutes.
Thank you, Mr. Chair. The lesson learned from the FTX collapse is that companies like FTX, offshore, deregulated, centralized, over-leveraged companies, have the highest risk of losing customer funds and defrauding their customers. My first question is for Mr. Belshi regarding the enforcement priorities of the SEC. Is the SEC prioritizing enforcement actions against the worst actors like FTX, the offshore, deregulated, over-leveraged, centralized actors, or is the SEC taking action against companies that are the opposite of FTX, onshore, regulated companies?
I'm not aware of any actions that the SEC took against FTX or Sam Bankman-Fried prior to its collapse. So you have to argue that it's the latter, that it's actually the folks that are trying to do it right. And you do have to wonder if we couldn't have avoided the mass amounts of money that flowed to FTX if the basic principle of a Bitcoin ETF had been provided and approved by the SEC when there had been 25 plus valid applications, some from Invesco and other reputable firms that have done ETFs for many years in the past.
The CFTC and the SEC seem to be engaged in a regulatory turf war over digital assets. In December 2022, the CFT, in a court filing, declared Ether to be a commodity. Yet in February 2023, SEC Chair Gary Gensler, in an interview with New York Magazine, disagreed with the CFTC, declaring everything other than Bitcoin to be a security. Mr. Graywall, is it fair to say that the mixed messaging from the SEC and the CFTC and the regulatory confusion it creates underscores the need for Congress to step in and bring legal clarity to the status of digital assets?
I believe it does underscore that point, Congressman Torres. As you point out, if the chairs of two of the most important regulators applicable to our industry and to this part of the economy can't agree on the security status of one particular token, that obviously speaks to the challenge for anyone else looking to stay on the right side of the rules and make proper determinations that are in accordance with legal expectations. So That is a long way of saying yes, sir.
Bloomberg opinion writer Matt Levine, who's no crypto cheerleader, made the following observation about the SEC's approach to regulating crypto, quote, "The SEC is being ruthless and creative about exploiting legal provisions to expand its powers, and the industry seems to be playing catch-up. What Mr. Levine describes as Mr. Gensler's creative use of his authority led him to declare Ether as a security and stablecoin as a security, even though neither one clearly constitutes a security under the Howey test." The Howey test has 4 criteria, as I understand it: an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. When it comes to a stablecoin, one might wonder, where is the expectation of profit? If I buy a stablecoin pegged to the US dollar, I'm not buying it because I expect a profit. I'm buying it in order to use that stablecoin as a digital dollar on the blockchain. Is that a fair assessment, or am I missing something, Mr. Graywall?
I think that is a fair assessment, Congressman Torres. It is absolutely the case that USD-backed stablecoins, such as those that you describe, come with no expectations of profit. There may be other problems with the Howey test, but of course, that one fatal flaw renders it anything but a security.
And Mr. Belshie, when it comes to Ether, like, where's the centralization? What's the central entity from whose efforts I, as an investor, would expect to derive profits with respect to a decentralized asset like Ether?
I think the determinations for this will, have to be argued kind of from both sides. It shows that decentralization is something that forms over time. It shows that the determination of these assets is clearly not clear at all. Perhaps Bitcoin, when it was started by one guy, was centralized. And yet today, no one argues that it's centralized. And the same thing applies for any new innovation. So some sort of incubation period where something can grow from a centralized status to decentralized seems warranted, and this is unique to digital assets.
I actually want to address that question to Coinbase. Are there assets that could begin as securities and then morph into something else as it becomes decentralized? The example would be Ether, that it was likely a security at the time of an ICO, but has become decentralized over time. What do you think of that analysis?
Speaking generally, Congressman Torres, I agree that assets can change character over time. And to be completely fair, I suppose it's equally true that an asset that began as a commodity might evolve into a security in some form as well. But certainly, assets which are centralized, which are controlled by a managerial group, can over time decentralize in ways that would take them clearly outside of any reasonable understanding of the definition of a security.
Gentleman from New York yields back, and we turn to the Chairman of the Housing and Insurance Subcommittee and Vice Chairman of the Digital Assets Subcommittee, Mr. Davidson, for 5 minutes.
I thank the chairman, I thank our witnesses, and I'm excited to finally have this subcommittee in existence and to have this hearing. As someone that's basically pleaded for this day since 2017, it's pretty exciting. On the other side, as somebody that's paid attention to this space, essentially since I got on the committee 6 years ago, it's painful to hear arguments that we've worked through in industry and with legislators and regulators since that time, and yet no actions happen. We have legislation that's been drafted on the shelves for years, and people in the industry are, publicly and privately coming in, when? When are we going to actually get something done? And I will admit, I'm a little dismayed when I hear some of my colleagues essentially continue to push either purposefully or through ignorance an idea that these assets are the same things as a centrally managed, centrally controlled database, when the entire computing architecture of this space structures it differently so that you can't have the same type of compliance tools in every application, but you can't have the same effect. You have to comply with it differently. And so as we talk about that, it's great to kind of bridge the divide, close the we don't understand it arguments, and just let people be exposed for the positions that they have. Towards that end, I ask unanimous consent to submit, for the record, statements from the Club for Growth, the Blockchain Association, the Chamber of Digital Commerce, the Crypto Council for Innovation, North American Federal Insured Credit Unions, I thank the chairman, and I just would ask Professor Evans, does the Securities and Exchange Commission regulate the payment system or securities?
Clearly, securities.
Yep, thank you. And, you know, the legal clarity that we're seeking, frankly, wants to make sure that investors, innovators, and regulators, like Chairman Gary Gensler, also know that the Securities and Exchange Commission doesn't regulate the payment system. Mr. Graywall, the CEO of Coinbase, Mr. Armstrong's made comments in the past in support of individuals moving crypto assets off exchanges and to self-hosted wallet, self-custody. Do you believe that protecting the customer's ability to eliminate third-party risk through self-custody is an important first step in consumer protection?
I do, Congressman, yes.
So for people that were caught in, you know, bad investments in the past, because this area has been unregulated and people have been abusive, outright misrepresented things, if they had custody of the assets and it was in their possession, what was their risk if the centrally managed unit collapsed or went bankrupt?
There would be none, Congressman.
Because they actually own their property. It's sort of like if the bank goes out of business and you have all your cash, even if you have an account with the bank, well, you didn't lose any money because you had your cash. Now, not everyone's going to choose to do that, but we certainly shouldn't prohibit it. Just like cash, we've made it almost illegal, but not entirely. And in this space, we've got people that are overtly trying to make self-custody illegal. Mr. Graywall, how does Coinbase work to prevent market manipulation, fraud, or conflicts of interest, things that would be barriers to making the spot market function?
Congressman, we have important policies and procedures to address each of those concerns, but our programs go far beyond just what we write down in paper. We have transaction monitoring systems. We also monitor for inside activity. All of these things are aimed at identifying behavior that would give concern not only to regulators, to lawmakers such as yourself, but to Coinbase itself, because our entire business proposition, our entire value for our customers is grounded in trust.
Yeah, thank you for that, and maybe particularly so now as a publicly traded company, so I thank you for that. I think it's important to address one of the issues in the space with Silvergate. I wish I had time to go into depth with some of the questions, but fundamentally, the run on their assets was precipitated by fraud. I mean, the shiny object was digital assets and crypto that led people to create accounts and relationships with FTX. But does anyone care to comment on why did FTX fail? Was it because they held digital assets, or was it because they commingled funds and committed fraud and misrepresented what they did?
So I'll try. So FTX made a fundamental misrepresentation, which is that they claim to have an exchange, which is a part of trading infrastructure. And with all of our trading infrastructure, we want to see well-understood risks and controls, whether you're a broker-dealer, an exchange, or otherwise. And what they did is they took funds out of that exchange and sent it over to their prop trading firm against the knowledge of their clients.
Thank you, and I yield.
Thank you, Mr. Davidson. We turn to my friend from Houston, Texas, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman, and I thank the ranking member as well for providing us this hearing. Friends, I was here when Bernie Madoff made off. Need I say more? Now we have FTX. I'm really concerned about the investors. I appreciate a desire to innovate, but all innovation isn't positive. Credit default swaps were an innovation that proved to be quite detrimental. Mr. Reiner, you've iterated previously on this topic, but what do we need to do to protect investors?
Thank you, Congressman Green. So to protect investors in crypto, you simply need to impose the same standards and safeguards that have long been present in traditional securities markets. You have to have segregation of customer assets from firm assets. You have to have adequate disclosure so that investors can make informed decisions about how to risk their capital. You have to have these firms produce audited financial statements, not proof of reserves. You have to have prohibitions on conflict of interest. You can't allow these firms to front run their own customers is what's happening currently in crypto markets. So, I mean, this is not rocket science. You know, the blueprint is there. It's just a matter of, you know, Congress clarifying once and for all that one agency, I prefer to be the SEC because they were created to protect investors. The CFTC does not have an investor protection mandate. Okay? And the markets that the CFTC oversees, commodity derivatives markets, are principally made up of large, sophisticated institutional investors. They don't have a long history of protecting retail markets. So it's not that complicated. We figured it out. Generally speaking, of course, there's going to be frauds from time to time, just like Bernie Madoff. You know, but the recipe is there.
Well, some of your colleagues seem to think that this in some way would thwart innovation and prevent these businesses from developing appropriately. What is your retort?
Well, of course, I reject that premise. You know, U.S. capital markets are the envy of the world. And there's a variety of reasons for that, but one of them is that we have a robust regulatory environment, that you can deploy your capital here with adequate information, that you have legal remedies available to you. So for the crypto industry to benefit long-term, it's going to need those same guardrails. Obviously, there's a massive trust deficit right now with crypto. The average American just doesn't trust it, and rightfully so. So for this industry to succeed long-term, and you know, people can disagree with me on the underlying utility and merits of crypto, but I still think we can agree on the need for there to be a robust regulatory environment, because that will allow users to trust it and know that they have protections, and the industry will, you know, benefit, you know, perhaps over the long term. But absent those guardrails, you know, people are continue not to trust crypto, and it'll sort of be the plaything of, you know, technologically sophisticated individuals.
Well, thank you. Just a closing comment. I was somewhat amazed recently when I pulled up to a service station in a neighborhood wherein most of the people are wage earners, probably not sophisticated investors, and there was a Bitcoin ATM readily available. I really am concerned about people who assume that regulations exist that do not, that they are protected when they are not. It causes me consternation, and I'm not getting a great sense of belief that the industry is as interested in the investors as they are in making profits. I yield back the balance of my time.
Gentleman yields back, and Mr. Rose of Tennessee is recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch, for holding this hearing, and thanks to our witnesses for taking time to be with us today and sharing your expertise. I want to dive right in. Mr. Graywall, will you describe the existing, and this is a broad question, I know, but will you describe the existing regulatory structures for digital asset trading platforms and discuss the current authorities of the SEC and the CFTC when it comes to regulating digital asset trading platforms?
Thank you, Congressman. I can certainly speak to that issue with respect to Coinbase's own experience as a platform that is regulated here in the United States. Just to give you some sense of the scope of our oversight, we have something like 45 money transmission licenses across the United States. We are also licensed as a bit licensee under New York law. At the federal level, we have a registered DCM, and we are seeking to register an FCM with the CFTC. We are also registered as a money services business, an MSB, with FinCEN as part of the Department of Treasury. Even within the SEC, we actually have registered broker-dealers, 2 of them, I believe, but we're not able to do anything with them because there are no digital asset securities that are currently available for listing. So that is the broad landscape that we currently face. What we do not have, though, is a viable path for registration, either as a national securities exchange or as a broker-dealer ATS with the SEC. And that is, I think, an important part of the gap that we believe legislation could help fill.
Thank you. And this is for all of you, so we'll go across the dais down there when I get finished asking the question. It seems that in the digital asset space, much of the friction, at least in the U.S., is between who would be the primary regulator, given that we have separate securities and derivatives regulators. Previous Congresses have considered merging the two regulators to provide more regulatory certainty. A 1995 GAO report found that merging the SEC and the CFTC could yield a number of benefits, including reducing regulatory uncertainty, enhancing market efficiency and innovation, and increasing regulatory effectiveness. In 2012, now SEC Commissioner Hester Pierce called a merger of the SEC and CFTC politically difficult to engineer, but added that it would be a reasonable step towards much-needed regulatory consolidation. Additionally, the Treasury Department under President Trump also considered a SEC-CFTC merger, but ultimately opted not to pursue the policy. I'm curious about how each of your opinions about whether the digital assets industry would benefit from having a combined securities and derivatives regulator. And we'll start on my left and go across, if you don't mind, Mr. Belcher.
So it's easy to say digital assets. Today we classify at least 5 different types of assets as digital assets. We've got stable coins, we've got cryptocurrencies, we've got DeFi tokens, we've got digital property like NFTs. I think I'm probably leaving off some. Having a single regulator for 5 very diverse and different activities probably isn't exactly the right approach. I think we talk a lot about the SEC because of the definition of what's a security and what's not. In terms of what is a security, yeah, I think it should be under the SEC. I think it's unlikely to see a hybrid of the CFTC and the SEC. But then lastly, I think the right approach is what was mentioned earlier by Mr. Davidson, which is a principle-based approach to regulation of digital assets.
Professor Evans?
Yes, thank you, Congressman. If we were beginning today, and normatively as, or I speak normatively as an academic, what you might create, and ideally some hybrid version might be applicable, although I agree with my colleague that given the complexity and the nuances of the different types of tokens and coins, it's not likely. But if I recall correctly, in the enabling legislation for both the SEC and CFTC, there is some language that calls upon them to work jointly in some capacity, although it is rarely used. And I would lean into that language and see what might be created in light of things that already exist.
Congressman, although I'm not an expert on market regulation, I would just note in the federal banking agency space, there are multiple regulators and they serve different functions. And generally speaking, as long as those different missions and tensions are handled constructively, it is valuable having multiple regulators in the banking agency space.
Thank you.
Congressman, in the past, Coinbase has urged the adoption of a unified regulator across securities, commodities, and other types of digital assets. We, however, have recognized the political challenges that Commissioner Peirce and others have pointed to. The main point, we think, is to have a unified framework, even if it involves individualized or separate regulators. With the right rules, we can manage the complexity of different regulators taking their fair share.
Congressman, I'll quickly note that Paul Volcker also thought the CFTC and the SEC should be merged, and I agree with him on that. You know, and this divergence has very, frankly, bizarre outcomes. So in 2017, the CFTC permitted the listing of cash-settled Bitcoin futures contracts, while the SEC continues to, rightfully, in my opinion,
my time has expired, so
we have an ETF and a Bitcoin futures.
Would welcome your follow-up on that. Thank you.
Mr. Reiner, please feel free to answer his question in writing. Mr. Caston's recognized for 5 minutes.
Thank you, Mr. Chairman. So, Mr. Reiners, I hope you'll forgive me for starting with just a really simple question. What, in your estimation, is the market value of the total traded crypto assets today?
Well, I mean, you can go to CoinMarketCap, and I think it's a little over $1 trillion, although, you know, market cap when it comes to crypto is a troubling metric, frankly, because anyone can create, you know, a token, you know, hold a bunch for themselves, sell 10, you know, for $100, and then say, oh, you know, voila, we have $1 billion market cap token here. So,
You've anticipated why I asked the question. You know, you mentioned, you gave one of the pithier explanations of the FTX bankruptcy that I've heard, which I appreciate, that essentially that what you just described, FTT, there was more desire for dollars than FTT, and all of a sudden there was a run on the bank, as it were. If I understand the Silvergate bankruptcy, it's sort of the same story. It sounds like they were sort of doing dollar settlement of crypto trades, and all of a sudden there was more demand for dollars than they had in reserves. And so they had washed that out. Is that a reasonable characterization of the Silvergate bankruptcy?
yeah, Congressman, I think that's fairly reasonable. I mean, Silvergate suffered a liquidity crisis, so, you know, over 90% of their deposits were affiliated with crypto firms. And so once, you know, crypto melted down, of course, there was essentially a run on the bank. They had to sell assets to meet that run. A lot of those assets were fixed income assets that had gone down in value since the Fed started raising interest rates. So that, you know, they lost money on that. That was a hit to capital, and then, you know, it became a sort of, you know, capital liquidity play on one another and brought them to the brink of failure.
So the reason I started with the capitalization is I'm sitting here that, you know, Silvergate is described as one of the most important banks in crypto, and $12 billion bankruptcy, FTX, one of the major exchanges, $8 billion bankruptcy, Celsius, $4 billion, Genesis, $3 billion. I don't think I've left out any of the major bankruptcies. In aggregate, that's like $28 billion. If the major players in the industry are going bankrupt and accounting for 3% of the nominal value, I'm sort of saying, is the $1 trillion real or not? How much of the value of this is inflated? You know, I mean, $28 billion is the market cap of Walgreens. I'm not, like, I'm happy to be on the corner of happy and healthy, but, like, nobody would say that Walgreens is systemically important.
Yeah.
And so I'm left saying, like, given what you've done in the systemically important banking space, are there any legitimately systemically important crypto players? If this industry went away tomorrow, from a financial perspective, does it matter?
It wouldn't move the needle one bit on GDP, unemployment, anything. Chair Powell would probably never bring it up in any of his pressers. You know, we just had obviously a massive crypto failure, a crypto winner, $2 trillion in, you know, market cap, whatever that's worth, just evaporated. And yeah, this is not a systemic risk event, as you said. I mean, the average person is not feeling this or experiencing this in any meaningful way. And frankly, that's a policy success, a little celebrated policy success, because it could have been a lot worse. I mean, as we've heard today, the crypto industry is desperately trying to become integrated with the traditional financial system, which is frankly ironic given the origins of crypto was to exist outside the financial system. The very first Bitcoin block had a transaction, you know, had a text in there that said, you know, from the Times of London newspaper, Chancellor on brink of second bailout. You know, now they're looking for the banking system to, you know, for their salvation, which is ironic.
And I agree, I'm glad it's not, I mean, maybe there's no systemic failure because we've done such a good job of up here. I'm always willing to take credit for that. Maybe it just is not really that big, because if the $1 trillion is ridiculously overinflated, you know, we don't have a special subcommittee on Walgreens. I raise all that because I think you've made the good case of, you know, much of crypto as a security. There are other good cases to be made about it as a commodity. Is there any good case for crypto as a currency? Because I'm left saying, like, what is the value for crypto as a currency that isn't basically a late-night Glenn Beck gold bug ad? It's, you know, it's something that is finite, that is valued by a few people. But I can't pay my taxes in it, I can't pay my mortgage in it.
Well, I mean, it's far too volatile to be used as a medium of exchange, as a currency. If you're a merchant, why would you accept payment in something that could go down by 20%, you know, within an hour because Elon Musk sent out a tweet, right? It's completely failed as a currency. You know, even stable coins, people like to talk about them being used as a currency. The reality is, as Gary Gensler said, they're the poker chips at the casino. People use stable coins so they can speculate on overseas exchanges and in DeFi. Right? That's the main reason stablecoins exist.
And I realize I'm close to time, and I don't want to sound like such a Luddite up here, because I think blockchain is a fascinating technology. There are fascinating conversations about Web 3.0, but it strikes me that this conversation has become complicated because we've talked about it as a currency instead of acknowledging that this is a volatile thing. Blockchain is fine, but to be continued. But I think if we regulate it as one of the other things that it actually claims to be, we'll probably find a way through. Thank you. Yield back.
Gentleman yields back. Mr. Stile for 5 minutes.
Thank you very much, Mr. Chair. Mr. Chair, I'd like to just make a quick comment that I actually think that stablecoin has a lot of potential opportunity here, and I think it's something that I hope we spend a little time on this committee, because I do think, I disagree with the previous witness's comment. I think it actually provides us a lot of opportunity. Let me shift gears here, and if I can, Mr. Graywall, I'm going to direct some of these questions to you. I spent a lot of time thinking about how we get the policies here right, in large part because I think it's really important that we're innovating here in the United States of America rather than allowing a lot of these types of products to be offshore, in large part for the protection of Americans and American investors, American consumers. And if we look back at the FTX implosion, a lot of individuals were hurt, including many in the United States. As you know, as I know, as many people have learned, FTX was headquartered in the Bahamas, not here, although it had some domestic subsidiaries. The bulk of its operations were offshore, outside the protections of the United States government. If we want to if we want to protect investors and foster innovation, I think we need to be encouraging digital asset businesses to domicile here in the United States, not in foreign jurisdictions that have less robust rules and regulations of the road to protect people. But as I'm looking at the SEC, it seems like they're failing to provide a clear framework to facilitate responsible U.S.-based leadership on digital assets. And so the question here is, we've seen Chairman Gensler, he recently gave an interview this week in which it seemed like he may have waved off concerns that digital asset businesses would continue to migrate overseas. He said, quote, "We lose more if investors get harmed here," end quote. How do you view those comments? Where would continued digital assets offshoring be in relation to the investor outcomes that we want here in the United States?
Well, as an American cryptocurrency exchange incorporated under the laws of the state of Delaware, we obviously have a strong interest in seeing robust protections for consumers that recognize the need for innovation right here in the United States. I can't help but observe, however, Congressman, that even as we are debating issues such as what is the definition of a security or which agency ought to have primary jurisdiction over one element of the regulatory framework or another, other countries around the world are moving ahead. The UK, Australia, Singapore, I could list many, many other countries that are taking a sensible approach to these issues and are attracting real capital and real jobs that create real national security concerns for the United States if this gap, if this race continues unaddressed by our country.
So let's dig in on that a little bit, right? So there's a discussion of whether or not the regulatory path forward is clear or not. And so I want to go back to Chairman Gensler's comments in these regards. We've seen a flurry of enforcement actions from the SEC after many of the firms in the crypto space. And he was recently quoted as saying, quote, "The path to compliance is clear." Is I understand that kind of, in other words, he's arguing that digital asset firms can and should register with the SEC, and the failure to do so is a choice. That's how I heard that comment. Maybe you could share with me how you view that comment. And then further, in your interaction with the SEC, is the path to compliance clear for your firm or for firms in the same space?
Congressman, what I can say with respect to registration is that we actually share the goal. As I laid out just a minute ago, Coinbase is eager to be able to offer digital asset securities here in the United States under the supervision of the SEC. And so to that end, we have pursued registration under a number of different models, some that we have proposed, others that staff at the SEC have suggested. But to date, we have been unable to reach an accommodation and identify a path towards registration or that would result in registration for the simple fact that the current registration rules don't make a lot of sense when it comes to digital assets.
So I'm assuming you're going back and forth with the SEC. I know last summer you sent a petition outlining a series of questions that you had. Could you characterize your interaction with the SEC, and have you received answers to the questions that you asked last summer?
Yes, sir. In July of last year, we filed a formal petition for rulemaking under the procedures set out in the Administrative Procedure Act, seeking rules along the lines that we've been discussing. I would characterize our interactions with the SEC as always professional. We held no particular grudge towards the commission, even as we have strong policy disagreements. We have received no answer to our petition.
You received no answers to your petition. I think that says the future and the path here may be less than clear. We have an opportunity to clarify. Thank you for your testimony today. Mr. Chair, I yield back.
Thank you, Mr. Stahl. Mr. Stahl yields back. Mr. Nickel is recognized for 5 minutes.
Thank you to all of our witnesses for being here today, and a special welcome to Mr. Reiners, who is from Duke University in the great state of North Carolina. I saw that, and I imagine you have not been looking at your phone. I did look at mine and did note that Duke is up significantly at the half. And Mr. Chair, I'm sure we've been talking a lot about the SEC today, but you and the good people of the great state of Arkansas's 2nd District as well will be much more interested in another SEC at 7 o'clock tonight.
Looking forward to it.
But I'm glad to be working across the aisle to make progress on digital asset regulation. This emerging technology has incredible potential. It has the power to bring more fair and equitable access to financial services for everyday Americans, especially those who are unbanked. It also has the power to reduce costs, increase efficiency, and grow our economy. However, without proper regulation, digital assets can be harmful to consumers. Additionally, without clear rules of the road, we risk this technology revolution moving outside of the United States. I think it's essential to our economy and our national security that America remain the world's dominant financial center. Because of this, I'm happy to be co-sponsoring Chair McHenry's Keep Innovation in America Act along with Congressman Torres. This bill provides regulatory clarity needed to ensure crypto innovation remains in the U.S. and directs the Treasury Secretary to conduct a study on this issue so that we can better regulate it going forward. Mr. Reiners, what additional regulation do you believe is needed in this industry to encourage innovation here in America while also protecting consumers?
Well, Congressman, first, I appreciate the update on the Duke game because it has been on my mind, and I'll just note that we are peaking at the right time of year here. So I laid out in my written testimony what I think is the right approach here, and I would just push back slightly on the concept that there's any innovation here worth embracing. Frankly, I mean crypto's been around for 14 years. That's a pretty long track record to take a step back and look at the harms that it's caused and the benefits. And on the harm standpoint, the ledger is pretty long. It facilitates ransomware attacks, which have absolutely crippled America's small businesses, municipalities, and healthcare systems. It undermines our national security by sanctions evasion, terrorist financing. I would just note that North Korea stole $1.7 billion worth of crypto last year to fund their ballistic missile program. And then, of course, there's the environmental impacts associated with proof of work mining, and then the numerous, just investor losses as well as frauds, hacks, and scams. And so when you, look at that in its totality, what are the benefits that we're receiving in return? I don't really see any. So I think as lawmakers, you need to be clear-eyed about what's happening here. And so, because of that, investor protection, I think, should be front and center while also minimizing risk to financial stability. And so I think letting the SEC fulfill its mandate to protect investors and giving them exclusive oversight over crypto is the right approach. Now, I'll concede it doesn't necessarily mean that all the rules that apply to traditional securities firms should apply one-to-one for crypto firms. So one area that I think many people in crypto would agree with me on is, perhaps there is a need for a customized disclosure framework because the information that crypto investors want is probably different than what, a normal equity investor would want. And even Chair Gensler has, alluded to this point and noted that asset-backed securities have a different disclosure regime. But it's a long-winded answer there, but I think, the SEC is best suited to impose some investor protections here.
Thank you. Mr. Graywall, the Board of Governors of the Federal Reserve System issued a policy statement that confers new obligations onto state member banks regarding the permissibility of engaging in crypto asset-related activities. The policy statement seems like it significantly impacts the ability of the consumers to access the crypto ecosystem through safe and well-regulated outlets. How will this rule hurt consumers and innovation?
Congressman, the challenge, of course, with any new rule is that it has unintended consequences or downstream effects, which aren't necessarily contemplated at the time of its enactment. In this particular case, let me be very clear. We support rules for disclosures to consumers and investors that allow them to make informed decisions about what they're investing in, who they're banking with, and the like. So to the extent we all share that goal, we think progress in this way would be constructive.
Gentleman yields back. Mr. Flood is recognized for 5 minutes.
Thank you, Mr. Chairman. I'd like to thank our witnesses for coming today. I really look forward to hearing your feedback on some of the SEC's recent actions related to digital asset custody. Mr. Gould, I'm referring specifically here to Staff Accounting Bulletin 121, which asked public banks to hold custodied crypto assets on balance sheet. Can you speak to how this differs from how the OCC regulates custody?
Sure. Well, the SAB 121 guidance document that you referenced, begs the question of if a bank is subject to that guidance, and thus it has to treat the assets it's custodying as if they were on its balance sheet, it begs the question of what is the appropriate regulatory capital treatment for those assets. And at least to my knowledge, the answer is unknown at this point. The Basel Committee has proposed regulatory capital treatment, which is highly punitive, but to my knowledge, I'm not sure what banking agencies are telling banks that are attempting to custody digital assets and that are subject to that SAB 121 guidance, which again, I think has a chilling effect on their willingness to custody those digital assets.
And speaking of that potential risk to, discourage banks from taking custody, what do you think the practical effects will be on? If you were advising a bank board, if you were advising a CEO of a bank, what would you say to them about SAB 121?
I mean, I think it would be a question of the bank's risk appetite as well as its available capital and whether or not they want to devote high levels of capital potentially to engage in an activity, custody, which at least traditionally is not the most lucrative of activities.
Mr. Gould, I appreciate the answer, and I fear that investors would not be very well served by an environment where banks cannot custody digital assets. If banks can't provide these services, can you speak to who might fill the void? Is there a risk of American investors' crypto assets being custodied largely offshore? And that's been mentioned already today.
I agree. I think there is that risk, and obviously banks historically have custodied all manner of all manner of assets, whether they be electronically stored assets or physical assets. So banks have a long history of managing the risks associated with the custodying assets.
Thank you. Chairman Gensler claims that he wants investors' digital assets to be protected, but at the same time, the SEC has taken actions that have driven some of the safest, most highly regulated institutions out of digital asset custody. That just doesn't make much sense. He's created a situation where he's going to drive digital asset activities offshore and leave American investors less safe as a result. Next, I'd like to touch on the SEC's latest custody rulemaking. First, I want to express the importance of keeping a pathway for custodians with a state charter to become a qualified custodian under the rule. I wrote and passed the Nebraska Financial Innovation Act, which allows Nebraska state-chartered banks to custody digital assets. Other states like Wyoming and New York have their own pathways to becoming a digital asset custodian. I believe it would be a grave mistake for the SEC to cut custodians who are already regulated at the state level entirely out of the market. I'm also concerned that the SEC's updated custody rules effectively prohibit self-custody, could block new entrants to the marketplace. And from what I've heard, if a startup wants to issue a new crypto token, registered investment advisors likely would have trouble custodying the asset themselves with the rule's new requirements. This could present a significant barrier to entry for new issuers because it might take some time for qualified custodians to build up the technical capability to custody their asset. So, Mr. Graywall, if an issuer of a new crypto token wants to work with a qualified custodian, but no qualified custodian has built up the technical ability to handle their token, what would that issuer be blocked out of? The market? Do you view that as a potential concern?
Well, if there were no firm available because it lacked the technical capacity to serve that customer would remain unserved.
What should we expect? Mr. Graywall, the SEC's new custody rule expands its reach beyond funds or securities to assets, including all assets. Can you speak briefly to how this rule might affect the marketplace for things like paintings, baseball cards, NFTs?
Artwork and baseball cards are a little outside of my day job, Congressman, but I certainly think the fact that the rule does extend to all assets, as you suggest, is something that needs to be noted and paid very careful attention to. This is a dramatic expansion of the very strict requirements that apply to qualified custodians. And so I think that's something that a lot of industries, not just crypto, are going to be very interested in.
Thank you, Mr. Graywall. Mr. Chairman, I yield back.
Thank you, Mr. Flood. The gentleman from California, the ranking member of the Capital Markets Subcommittee, Mr. Sherman, is recognized for 5 minutes.
The title of this hearing says the administration's attack on the digital asset ecosystem. I just wish it was true. The administration is not doing all they can to try to keep this scourge out of our economic system. In fact, if there was a conspiracy against crypto in the Democratic Party, I would know about it. I would think they would have invited me to it. Unfortunately, it doesn't exist. We're told that we need to serve investors because we expect investors to provide the capital that drives our economy. Because when we hear the word investor, we think people who are building apartment buildings so people can live there. People who are building factories. We're dealing with investors in a burglary tool factory, or similar to investing in the North Korean economy. John Maynard Keynes, I think, coined the term animal spirits as a very valuable asset for a capitalist economy. The willingness of people to take a risk and an essential element in building an economy. And we in Congress have subsidized that to the tune of hundreds of billions of dollars a year. We do that through not only the capital gains allowance, but full forgiveness upon death of all capital gains on investments. Mr. Reiners, can you think of a reason why the incentives that we give to have people invest in housing and businesses should apply to those who are investing in a chance to undermine the dollar or at least partially displace the dollar as the world's reserve currency?
No, I cannot.
Now, when you have a strong incumbent in a business area and you're trying to partially, take market share, it's wise to name your company or your product after what you perceive to be its advantage. Jolt Cola has more caffeine. Says it right in the name. You want a Jolt? Cryptocurrency's done the same thing. Cryptocurrency literally means hidden money. Mr. Reiners, can you think of some people who would find hidden money to be better than unhidden money?
Of course, people who wanted to do bad things.
Evade tax laws would be the biggest market. Sam Bankman-Fried is right now hoping that he can evade bankruptcy laws and keep his assets out of the hands of his claimants. And the one thing I do want to say to my colleagues here is we can't trash Sam Bankman-Fried and then support his bill. He wasn't around here as a shorts fashion model. He was around Rayburn and Congress for one purpose, and that was to keep the SEC out of crypto. They want the patina of regulation, but they don't want the most effective business regulator. Mr. Anders, a currency is supposed to be a store of value and a medium of exchange and a measuring stick of value. Does the dollar do that?
Yes, very well, and it has for a long time.
So aside from the fact that it's hard to hide from the IRS and sanctions evaders and those enforcing our human trafficking laws and and those enforcing our laws against drug dealing, what flaws does the dollar have that cryptocurrency could, can you think of anything that crypto adds to people doing honest transactions in conformity with U.S. law?
I cannot.
And it's talked about as if crypto is a better payment system, but as I understand it, if I want to transfer crypto to somebody and then they want to buy a sandwich with it, I've got to pay something to I've got to take my dollars, pay a fee, convert it to crypto. They then get the crypto. They have to pay a fee, convert it to dollars, and go down to McDonald's and buy a hamburger. Is that an efficient payment system?
No, not at all. And I would point out the fees in the crypto economy are quite high when you compare them to securities markets.
Thank you.
Gentleman yields back, and votes have been called on the House floor, and we will continue our questioning until we've got about 200 votes left. And we will now turn to Mr. Timmons for 5 minutes.
Thank you, Mr. Chairman. I want to start off my time by saying that I look forward to working with all of my colleagues on the subcommittee as we continue to shape foundational legislation for the digital asset ecosystem. The digital asset space has garnered a great deal of headlines recently, and I think the call for legislative action is building serious momentum. Even more so, recent aggressive actions by regulators show that Congress needs to enact legislation tailored to the digital asset ecosystem that appropriately addresses the risks while ensuring the clear benefits of this new technology are not held back. Republicans on this committee have long advocated for increased collaboration with regulators to produce legislation that addresses the risk and benefits of the digital asset ecosystem. The SEC seems to want to classify all digital assets besides Bitcoin as securities, but I'm worried that this neglects the actual use cases for this technology and risks chilling development and innovation before the value of it is ever realized. Mr. Grewal, can you talk about some of the potential use cases for this technology outside of the finance space, as that is where the greatest promise seems to lie, in my opinion?
Thank you very much, Congressman. You are right to point out that within the financial space, of course, payments are important, and I would also call out remittances. Workers here in the United States are using crypto to send money home as we speak today, and are doing so faster, cheaper, and more secure than ever before. Outside of financial use cases, there are interesting and important new cases emerging every day. I'll just highlight a couple of them to answer your question directly. When it comes to carbon credits and other forms of environmental protection, blockchain-based technologies are able to help track those credits and make sure that they properly account for environmental remediation. There are also digital health records that are emerging that are blockchain-based and offering important value to patients who want to be able to have true data portability while protecting their personal information. Decentralized identification offers another important non-financial use case that we think can, again, facilitate attribution of activity online without the collection of highly intrusive, voluminous, personal identifiable information.
Would any of those potential uses you just laid out ever be realized if we regulate every token as a security?
It's not likely, Congressman. The fact of the matter is that our federal securities laws impose significant burdens on issuers, and in certain cases, those burdens are appropriate, where the tokens are, in fact, securities. However, many tokens are not securities. They offer practical utility in certain cases. They may operate as commodities in other cases. In any event, the burdens of the federal securities laws yield very little benefit, and as a result, net disincentivize productive economic activity.
Sure, thank you. Professor Evans, same two questions to you. Could you talk about potential uses that maybe he didn't touch on, and what would happen if we regulate every token as a security?
Thank you, Congressman, for your question. I am very excited, actually, about use cases regarding identity. The idea that you could go to a store, if someone is has to be 21 to buy a product, they don't need to know, even as a matter of personal security as a woman, where I live. You just need to know whether I'm over 21 or under 21. And so uses of that nature are very intriguing. There are other use cases beyond NFTs for collectibles as well that go into healthcare and all sorts of other intriguing issues. Final point, I think of supply chain issues as well. Not everything will use cryptographically secured assets, but certainly the underlying technology for distributed ledgers.
Thank you for that. Crypto is a $1 trillion industry by market cap, and although regulators may want to move quickly to manage risk, it is imperative that this is done in a thoughtful and reasonable manner. The January joint statement by the banking regulators highlighting liquidity risks associated with certain sources of funding from digital asset entities, and last month's final rule by the Federal Reserve essentially prohibiting state member banks from holding digital assets as principal and discouraging federal banks from engaging with the industry. Both of those things are very concerning to me. I don't find them to be thoughtful or reasonable. Mr. Gould, with few banks willing to provide banking services to companies in the digital asset space, how does the example of Silvergate demonstrate the risk of overconcentration?
Well, I think in part the agency guidance runs the risk of being self-fulfilling, right? In that they're warning about concentration risk, and of course that is having the understandable impact of making banks even more hesitant to bank crypto entities or crypto customers. And so you can see the continued kind of shrinking of the number of banks that are willing to bank those customers, and thus further concentrating the risk in the very few remaining banks that will bank them.
Thank you for that. Thank you, Mr. Chairman. Now you're back.
Gentleman yields back. The gentlewoman, Ms. Houchin, is recognized for 5 minutes.
Thank you, Chairman Hill, to the ranking member and the witnesses for your testimony, for speaking with us today. Crypto, digital assets, other areas of financial technology have shown immense potential and opportunity over the last several years, especially as the total market capitalization for digital assets has risen above $1 trillion. And technologies like blockchain and stablecoins continue to change the ways that Americans interact with the financial sector. Despite this, you've all highlighted companies in the digital assets industry face great difficulty when trying to do business and grow here in America. From a lack of regulatory clarity from our federal agencies to a restrictive approach from the administration, threats to the industry may push innovators elsewhere, causing the U.S. to lose its leading role in digital assets. Mr. Belshi, in your testimony, you highlighted the need for regulatories to move quickly and alongside innovative businesses. What would be the impact on U.S. competitiveness within the global economy if we continue at the current pace?
I think we're currently on track to move this industry mostly out of the United States. Now, some might like that in this room. I think those of us on the panel are mostly not that way. Look, Americans are seeking out these assets. We've heard statistics, 20% of Americans are interested in touching digital assets today. The use cases are many, and they keep coming quickly. So there's a whole technology sector here which is at risk. And someone had asked the question of what if we just turned it off today and what impact it would have. Well, let's take Paul Krugman's quote from back in, 1998, when he said, hey, the entire internet is going to have no more value than the fax machine. And what if we had taken his advice and just turned it off back then? Yeah. The use cases, that we just heard a few moments ago, there are many. There's many that haven't even arisen yet. So it would be, I think, devastating to the American business.
Thank you. We've heard some testimony today suggesting that a regulatory structure is, quote, not a race. But isn't there great risk to American leadership and competitiveness on the world stage and to the stability and preeminence of the U.S. dollar if we fail to establish clear guidance and rules for digital asset innovators while other countries appear to be moving full speed ahead? Mr. Belshi?
That's what is happening, and then I think it gets a little bit worse because this does overlap with money and finance, so it's not just a business issue, it's actually a political power and dominance issue. China has got a CBDC. It's not perfect, but they are exploring it. They're exporting it all through, Belt and Road. And a few years from now, they will have a large economy on which they control. So the U.S. has a choice as to whether it wants to participate, and we need to make that decision now.
Is it also fair to say that the lack of action on how to define and regulate crypto over the last few years under this administration and the movement of the crypto industry overseas to unregulated places like the Cayman Islands might have been avoided with a program of oversight like you are seeking?
For sure. We've flip-flopped even without changing the legislation. And I think, everybody here should be concerned about that. The OCC opened for business for digital assets just a couple of years ago and then slammed the door shut. The laws didn't change, the regulations didn't change, and yet the administration changed. This is a problem.
Mr. Graywall, several countries and international organizations have begun to introduce and implement regulatory frameworks for the digital asset ecosystem, including the European Union, which has worked tirelessly in the markets and crypto assets regulation. What is the impact that efforts in the UK, Japan, China, and the EU will have on the regulatory environment for digital assets in the US? And what has prevented the United States from leading the charge for a digital asset regulation globally?
Thank you for the question, Congresswoman. There's no question there is tremendous creativity and progress being made in many markets all over the world. You've listed several of them. And I want to be very clear that that progress and creativity is not simply about allowing the crypto industry to do whatever it wants. These are serious democratic jurisdictions that are imposing strict limits on what these crypto firms can do, like ours, and imposing strict requirements on know your customer, AML rules, all the security issues that are important. So this is not a race to the bottom, Congresswoman. This is very much a race to the top, and right now we're losing in this country.
I couldn't agree more. I thank you so much. Digital assets and crypto, in my view, is the space race of our generation. We have to figure this out. Not that we're doing it too quickly. We are going to do it expeditiously, but we can't not do it. In order to bolster America's global leadership, ensure national security, support innovation in our financial markets, it's vital to cultivate an environment that allows these technologies to grow. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. Mr. Donalds of Florida, recognized for 5 minutes.
Thank you, Mr. Chairman. Witnesses, thanks for being here. You know, Mr. Chairman, I'm actually, as some of my colleagues were going through questioning, I'm reading through testimony, actually reading the president's budget right now, which is comical in a lot of areas. And it strikes a real interesting question for me. We here in Washington, D.C. have a habit of creating program after program after program and spending hundreds of millions and billions of dollars. We pat ourselves on the back. We say these programs work. We have no idea of the efficacy. We borrow trillions of dollars more to continue the spending. And we just rinse and repeat the programs and then add to them. Conflating that with, we have a burgeoning industry on our hands, and the first step is to figure out who or who's going to regulate it, how quickly, without asking the first fundamental question of, does the SEC or the CFTC even have the technical capacity or know-how to regulate the industry that they both are clamoring to get their hands on? Especially Mr. Gensler, like he's ready. This guy's, he's frothing at the mouth, Mr. Chairman. So I'm confounded by this because we've been through regulatory schemes in the United States before. The most recent large-scale regulatory scheme came after the financial collapse. We all know it as Dodd-Frank. Dodd-Frank has been an albatross across community banking in these United States. And yet, in the president's own budget, he has billions of dollars more for programs for small business owners through SBA, more program dollars through the Minority Business Outlet Fund, whatever we want to call it, when the real remedy is actually a more streamlined regulatory environment for the banking industry so community banks can flourish in these United States, so businesses, whether they're owned by Black people, Hispanic people, white people, rich, middle income, poor, all have access to capital to grow their businesses without Washington having to appropriate dollars into these funky programs that we know are average at best. Which brings us back to digital assets. And this is really a question for all of the witnesses. Do the agencies that currently exist have the technical capacity to adequately regulate a digital assets space? And then the second question to that is, if they don't, wouldn't it be better for Congress to do something novel and actually create a regulatory sandbox so that the industry can actually prepare the regulatory environment, since they have the technical capacity way past anybody over at the SEC, especially considering, from what I hear, Mr. Gensler works everybody like a dog over there. Mr. Belshie, you can go first, so we can go down the list.
Well, on the technical capacity, I think that might not be the best question, but the principle-based approach will give some flexibility in how we move forward. I do agree with you. If you hand it to the existing regulators, it will have a tremendous gravity to end up with the same market structures that we have today. The same market structures we have today aren't perfect. There's a lot of inefficiencies. The bankers participating in those systems are making more money today than they've ever made before. We can do a lot better. So you have to foster the innovation to get a better market structure. This isn't to avoid market structure. It's to recognize that the technology in front of us today can settle transactions in real time, all the time, not having to go through 4 different middlemen.
Ms. Evans.
Thank you, Congressman. This is kind of a both-and answer for me, because on one hand, I have great respect for Hester Peirce, for example, in the SEC. I think she's been very thoughtful in how she approaches it. I think of Commissioner Kristen Johnson on CFTC, also very thoughtful for a long time. But to your point, technical capacity in this space is critically important. As a professor, obviously, I'm always going to lean into education, but it has to be education to have true subject matter experts. Whether they agree or disagree, they have to understand the fundamental underlying technology, or it's difficult, if not impossible, to regulate efficiently and effectively.
Quick follow-up, Ms. Evans, for you. Do the agencies have that educational know-how for this fledgling industry? Yes or no?
It's difficult for me to say without knowing the inner workings. I've not seen much from the perspective of leaning into the language of it, but I think a lot of education can go around in all spaces on the legislative and the regulatory side.
Ms. Evans, I would postulate that answer is no, and that's no disrespect to your answer, but considering how fresh this technology is, I doubt people who've been in the agency space for 5 to 7 years have that ability. Gentlemen, I know I'm out of time, and I apologize. I really wanted to hear your answer, Mr. Rainers. I really wanted to hear that, but you know what? You could submit it to us. I'd love to see it. Thank you, Mr. Chairman.
Thank you, Mr. Jones. Mr. Nunn's recognized for 5 minutes.
Thank you very much, Mr. Chair, and thank you for letting me join the subcommittee on the administration's attack on digital asset ecosystem. Team, as we've heard from our colleagues today, I think we are very excited about the potential for this technology, and we want to make sure that if we're not defining the rules of the road, someone else in the world will, and we need to be forward-leaning on this. Unfortunately, throughout many of the last couple of years, the administration's regulatory enforcement approach has failed to provide adequate protections for our digital asset market. Blockchain technologies and digital assets, as we noted, are here to stay in the United States. Personally, I served as a military officer for nearly 2 decades, particularly in the intelligence area, operating against Russia and China. After 9/11, I deployed multiple times and served thousands of hours working in counterintelligence, specifically serving as the Director of Cybersecurity at the NSC. And that's why I'm introducing the Financial Technologies Protection Act of 2023, which will establish an independent financial technology working group, as my colleague highlighted, to combat terrorism and illicit financing through use of these financial systems. Because not only can digital assets be used for good, they're clearly being used for ill. This will be chaired by the Secretary of the Treasury, acting under the Secretary of Terrorism and Financial Intelligence, senior level representatives from the Department of Justice and the United States Secret Service, the Financial Crimes Enforcement, and the Federal Bureau of Investigation, among others. Additionally, we include 5 appointed by the Undersecretary for Terrorism and Financial Intelligence to represent financial technology companies, financial institutions, and organize and engage in this research, building both a public and private enterprise to be able to address these threats. This working group will conduct independent research on terrorism, their illicit use of new financial technologies, while also developing legislative and regulatory proposals to improve anti-money laundering, counter-terrorist, and other illicit efforts in this space. I believe now more than ever, we have witnessed over the last year with Russia's unprovoked attack on Ukraine, our constituents must know their representatives are doing everything they can here in Washington. We must protect families not just in my home state of Iowa, but across the United States, and make this space a successful area for those who want to do well. Director Gruhl, I'd start with you as Chief Legal Officer at Coinbase. We hear a lot about the risk that crypto might move offshore, given the lack of regulatory clarity and the approach being taken by our current financial regulators, seeming to restrain this industry. Could you explain the downsides associated with a crypto company that were to move offshore and the threat it could have from that terrorist element?
Thank you, Congressman. Well, as I've indicated earlier, we are not only an American company incorporated here in the United States, we are a proud American company, and we very much intend to continue to invest in the United States and this market, even as we pursue other opportunities around the world. The fact of the matter is that as regulatory clarity emerges in jurisdictions other than the United States, it becomes more and more attractive to invest capital, to place jobs, and to develop technologies outside the United States for the simple fact that we know what the rules are. We know where the boundary is. We know where we have to go to avoid even getting close to that boundary. And there is a material impact, there will be a material impact to the security of the United States if those technologies are developed outside the U.S. Because for one simple reason, Congressman, our sanctions programs, which you alluded to in your comments, are at the core of our ability to prevent bad actors from gaining access to funds which facilitate bad acts. You can't have an effective sanctions program based here in the United States if the technologies that would be subject to those sanctions programs are being developed elsewhere.
Very good. Mr. Belcher, I'd like to ask you, we just talked about the left and right parameters of this, being able to control not only the sanction aspect of it, but the additional elements of having an uncontrolled currency that the United States would have a very hard time getting its arms around if we're not part of the process in developing a digital asset which the United States has control over. Could you talk to us about the national security implications?
Sure. Look, we could ban cryptocurrencies and digital assets in the United States, but it won't prevent them from being used outside the United States.
Right.
So we either figure out how to bring it in and have the best chance of understanding it, helping lead the world in terms of the rules around how you manage it, or we delegate that to someone else. So the choice is ours. I think we want to manage that rather than give it to others.
Thank you very much. I think that we have a responsibility to help define this battle space, one that is favorable to the United States, one that helps grow our economy, that helps us innovate and be a leader in this space, and not be on our back heels being responded to by those who would be adversarious towards us or those who would use it for a nefarious process. Committee, I really appreciate your testimony today and the great wealth of knowledge that you've offered us. Mr. Chair, I yield back.
Gentleman yields back. I'd like to thank our witnesses for an outstanding panel and appreciate all the participation of our members. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, and they'll be forwarded to the witnesses for the response. I hope our witnesses will please respond promptly as you are able. This hearing is adjourned.